Close your eyes for a second and imagine this. You wake up tomorrow morning. You check your bank account. The number is higher, not because you worked extra hours, not because someone sent you money, just higher. No alert, no explanation. That sounds like magic or a glitch. But here's the uncomfortable truth. That exact thing happens every single day at a massive scale. Legally, quietly, intentionally. Money is created out of thin air, not by printing presses running all night, not by secret vaults full of cash, by keystrokes. And once you see how it actually works, it becomes very hard to unsee. Because this system doesn't just affect banks or governments. It affects your rent, your savings, your future, and the value of every hour you trade for money. Let's rewind. Why does this matter right now? Because most people feel something is off. Prices keep rising. Houses feel permanently out of reach. Salaries chase inflation but never catch it. And everyone keeps saying the same vague phrase, there's more money in the system. More money than what? Where did it come from? To understand that, we have to forget everything we were casually told about money growing up. Forget piggy banks. Forget gold bars. Forget the idea that money is a limited pile of stuff. Money today is not a thing. It's a system of promises. And the moment you understand who is allowed to make those promises, everything changes. Let's start very small, almost childishly simple. Imagine a tiny village. 10 people. 1 baker, 1 farmer, 1 carpenter. Everyone trades goods, bread for milk, milk for tables. It's slow and awkward. So someone invents money, tokens, pieces of paper. Everyone agrees they represent value. Important detail. These tokens don't have value because of the paper. They have value because everyone agrees they do. Now imagine the village creates a bank, a trusted hut with a lock. People deposit their tokens there for safekeeping. The banker gives them IOUs. You own 10 tokens. So far, nothing strange. The bank has 100 tokens inside. It has issued IOUs worth 100 tokens, 1-to-1. Honest. Boring. Now, here's where the story turns. One day, someone comes to the banker and says, I want to borrow 10 tokens to build a bigger oven. The banker looks inside the hut. There are 100 tokens. But here's the key realization. Not everyone comes to withdraw their tokens at the same time. So the banker doesn't need all 100 sitting there. The banker gives the baker a loan. But instead of handing over physical tokens, the banker simply writes a new IOU, account balance, plus 10. Pause right there. Those 10 tokens did not come from anyone else's account. They were not transferred. They were created out of nothing. The village now has 110 tokens worth of purchasing power floating around, even though only 100 physical tokens exist. And nobody panics. Because it works. This is not fraud. This is not a bug. This is the foundation of modern money. Fast forward to today. Replace the hut with a global banking system. Replace tokens with digital numbers. Replace the village with entire economies. The principle is identical. When you take out a loan from a bank, the bank does not lend you someone else's money. That's the first myth to kill. The bank creates new money the moment the loan is approved. Your account balance goes up. The bank's balance sheet grows. New money enters the system. If that sentence makes you uncomfortable, good. It should. Because this means most money you see around you did not exist yesterday. In most modern economies, over 90% of all money is created this way, as debt, not printed, typed. Now, let's slow down and make this painfully clear. If you borrow $100,000 for a house, the bank does not go into a vault and pull out someone else's $100,000. It credits your account. Click, the money appears. On the bank's books, it records 2 things at the same time. An asset, your loan. You owe them $100,000 plus interest. A liability, your deposit. They owe you $100,000 on demand. Balanced, clean, legal. The money exists because you owe it back. Money is born as debt. And this is where the system starts to get interesting, because that $100,000 you spend doesn't vanish into a void. It goes to the seller. The seller deposits it in their bank. That bank now has more deposits, more money, which means it can create more loans, which creates more money. This is not a straight line. It's a feedback loop. Banks don't wait for savings to create loans. Loans create savings. Read that again. Loans create savings. This flips the common story upside down. We're told banks take deposits and lend them out. In reality, banks lend first, then deposits appear. This is why money supply can grow so fast without printing presses overheating. Now, naturally, you might ask, if banks can just create money, why don't they create infinite money? Good question. There are limits, but they're not what most people think. The limit is not how much cash exists. The limit is whether borrowers are willing and able to take on debt, and whether regulators think the system is stable enough. Which brings us to central banks. Central banks are often described as printing money. That image is outdated and misleading. Central banks don't usually give money directly to people. They influence how much money banks create. Think of the central bank as the thermostat. It sets interest rates. It decides how cheap or expensive borrowing is. Lower rates. Loans feel painless. Borrowing explodes. Money creation accelerates. Higher rates. Loans hurt. Borrowing slows. Money creation contracts. During crises, central banks do something even stranger. They create money to buy assets, government bonds, financial securities. Again, not with trucks full of cash, with keystrokes. This injects money into the financial system, lowers yields, and encourages banks and investors to take more risk. It's called quantitative easing. The name sounds technical. The effect is simple: more money chasing the same assets. Now, let's talk about the uncomfortable math. If money is created as debt, what happens when everyone has too much debt? The system requires constant growth to function smoothly. More loans tomorrow to pay off yesterday's loans, more money creation to service existing obligations. If growth slows, cracks appear, defaults, layoffs, recessions. This is why modern economies fear stagnation more than almost anything. No growth means the debt-based money system starts to seize up. And here's the quiet irony. We're told to be responsible, save money, avoid debt. But the system itself is built on expanding debt. Someone has to borrow, or the machine slows. Now zoom out. Who benefits first when new money is created? Not you. New money doesn't spread evenly. It enters at specific points: banks, financial markets, governments. Assets get bid up before wages catch up. Stocks rise, real estate rises. Speculative assets inflate. By the time the money reaches everyday prices, the purchasing power has already shifted. This is why asset owners tend to benefit first, and wage earners feel squeezed. It's not a conspiracy. It's a transmission mechanism. Money enters the system somewhere, not everywhere. Now, to be fair, this system has upsides. It allows massive projects to be financed. Infrastructure, innovation, growth that would be impossible in a purely fixed money world. But it comes with a cost. Instability, booms and busts, periods of artificial calm followed by sudden stress, and a growing sense that the rules are abstract, distant, and hard to challenge. Because money feels real, but its creation is invisible. No sirens, no headlines, just balance sheets adjusting quietly. And here's the part that usually makes people pause. When a loan is paid back, that money disappears. The bank deletes the deposit. Poof. Money is destroyed. Which means the system is constantly creating and destroying money, like a heartbeat. expand. Contract, expand, contract. Your financial life sits inside that rhythm. So when people say, there's too much money in the system, what they really mean is this. There is too much debt relative to real productivity. Too many promises chasing too few real goods and services. And that imbalance shows up as inflation, bubbles, and stress. Now, step back one more level. Ask yourself this. If money is created out of thin air, who controls the air? Banks operate under rules. Central banks set conditions. Governments back the system. But the average person interacts with money as if it were a natural force, like weather, something that just happens. That's convenient, because systems you don't understand are very hard to question. This is why the story matters. Not to scare you, not to sell you anything, but because understanding how money is born changes how you see risk, debt, and stability. It explains why crises feel sudden, why recoveries feel uneven, why saving feels harder than it used to. It also explains why every generation feels like the game got more complicated. Because it did. We moved from physical limits to abstract ones, from gold to promises, from scarcity you could see to scarcity you feel. So here's the unresolved question. If money can be created with keystrokes and destroyed just as easily, what exactly are you working for? A number, a promise, a claim on future goods. And what happens when faith in that system is tested again? That question has no clean answer. But once you see how the magic trick works, you start watching the hands more closely. And you realize the real story of money isn't about paper or coins. It's about trust. And trust, once stretched, doesn't snap loudly. It frays quietly. That's the part worth thinking about.